Hello, welcome to this little extra video. It's pretty short. It just deals with what we've talked about, but from a balance sheet perspective, so you can see example transactions. So let's start off by looking at, what basic banking looks like. And we've got a bank called the First National Bank. You can see it here. There are two balance sheets there. We look at the situation where there's, first of all, a cash deposit. So how does that work? Well, on the left hand T balance sheet, in other words, you have $100 coming in as checkable deposits, and you can see they just go, that $100 in cash, presumably goes straight into the vault. So there it is. So it becomes part of the bank's reserves. So you can see that on the right hand side T. So, what happens if you have a check that's deposited rather than cash? Well, pretty similar thing. You have checkable deposits going up by $100 on the right-hand side of that T at the top of the page. And then on the left-hand side, you can see that now, instead of being shown directly as cash, it's called cash items in process of collection. That means it's a check that's basically going through the system. And how does that check clearing work? Well, you can see that on the bottom. Basically, that adds eventually to reserves for First National Bank. And when you look at Second National Bank, the bank that check's written on, their checkable deposits are going to go down by 100. So that's on the right-hand side, right-hand T there at the bottom of the page. And their reserves will go down by 100. So how do banks make profits? Well, they take those checkable deposits that come in, and of course, they have to put aside the required reserves. You can see that there is 10, if it's a 10% required reserve ratio, and then they have the excess reserves of 90, and obviously they're not going to just let those excess reserves sit around. They're going to lend them out, and you can see that happening on the right-hand side. Those excess reserves become loans. Notice that in each case, the left-hand side and the right-hand side of the balance sheet always add up to the same amount. So in this case, we're looking at the changes in the balance sheet. And, the idea of asset transformation is that the bank sells liabilities with one set of characteristics and using the proceeds buys assets with a different set of characteristics. So the characteristic of the checkable deposit, the contract to pay interest on that you sign when you open up an account will be very different from the level of interest and also the conditions of the contract given out in the loan that the First National Bank has there. And the bank usually ends up borrowing short, so short-term borrowing and lending long. These are the general principles of bank management. So here we're going to go through again what we did in that chapter, but instead deal with each in terms of balance sheet examples. So liquidity management, asset management, liability management, capital adequacy management, credit risk management, and interest rate risk management. So let's first of all start off with liquidity management. If a bank has excess of reserves, you can see that in this particular example on the left-hand side. This is a very simple balance sheet. Notice this isn't change. This is actual amounts in the reserve in assets and liabilities. So you can see this bank initially has deposits of 100 million, bank capital of 10 million. It's obviously determined by the assets minus the liabilities. So let's have a look at the assets. We've got reserves of 20 million, loans 80 million, and securities 10 million on the left-hand side. So now let's assume that a member of the general public who has a deposit account, a checking account at that bank comes and decides to take out 10 million. Well, on the right-hand side, you can see that immediately the deposits go down by 10 million to 90 million. On the left-hand side, that means that the reserves must go down by 10 million. So suppose that the bank's required reserves are 10%. So now it has 10 million as a percentage of 100, so it's fine. Okay. So if a bank have ample excess reserves, and you could see that was the case on the left-hand side, T, then when someone comes and takes out large amounts of money, then that's not going to, all it's going to do is run down the excess reserves, and the bank will still be compliant with minimum reserve requirements. Let's take an example where, in terms of liquidity management, we are just meeting minimum reserve requirements and someone comes and takes some money out. So that's the case here. So on the left hand side, that T, you have similar situation, 10% reserves, and you can see the that's out of 110. Well, it's a bit more than 10 out of 110 is actually a little less than 10%. So that's not in compliance, in fact, there on the left-hand side. So if someone comes and takes out 10 million, then this bank will be in real trouble because it has no reserves. On the left-hand side, it was a little under in terms of its reserve requirements. It should have had something like 11.1 million to be 10%. But on the right-hand side, now that someone's come and take the money out, it's really completely out of compliance. So those excess reserves are an insurance, they're a cushion, if you like, against costs associated with deposit outflows, because that bank now, particularly in the case where it is on the right-hand side, it has to do something pretty quick. So we're going to look and see what it can possibly do. So first of all, we have to look and see, what its total assets are. And you can see, going back here, its total assets end up at 100 million. So if reserve requirements, minimum reserve requirements are 10%, it needs 10 million in reserves. So it's gone out and borrowed 9 million here, and those become its reserves. Obviously, there's going to be some costs incurred because it's going to have to borrow that money, and it's going to have to pay the interest. So that's one solution. Second solution is it can just basically, it's 10% of deposits, isn't it? So it needs 9 million in reserves, not 10 million, 9 million in reserves. So security sales could be the other option. So it has 10 million in securities, just sell 9 million of those. Once again, it's got the reserves. So it's manipulated its asset side of the balance sheet here. What's the cost? The cost of selling securities is probably the brokerage fee and other transaction costs, and it may make a loss on those securities if the timing isn't right. So that's another cost there of doing it. Probably the most preferred way that banks get over this type of problem, as long as it's temporary, is to go to the Federal Reserve and just borrow from the Fed. That's done obviously at the discount rate, and you can see that appears in liability side of the balance sheet, but it also now allows the bank to have 9 million in reserves. Obviously the cost here will be the interest payments based on that discount rate. This is the least favored as far as the banks are concerned, and that is to reduce their loans. That means calling in some of their loans. In this case, they need to call in 9 million of their loans. That takes their loans down to 81 million, and that gives them the 9 million reserves that they need. It antagonizes customers, and banks may only agree to purchase those loans at a substantial discount. So that's a problem as well. In terms of asset management, there's really three goals: seek the highest possible returns on loans and securities at the least risk possible, and have adequate liquidity. And so what do banks do? Well, first of all, they try and find borrowers who are going to pay high interest rates and have the lowest possible probability of defaulting. They're going to purchase securities with high returns and low risk. That tends to be agency securities. Interestingly enough, the government agency securities are very popular with banks. And they obviously want to lower their risk as a bank by diversifying. That means if something goes wrong in one part of the economy, it won't bankrupt the bank. And also they need to balance the need for liquidity against increased returns from less liquid assets. So they've got to make sure that they can cover if anyone wants to pull out their deposits. And liability management is, instead of managing assets, looking at the liability side. It's a recent phenomenon due to the rise of these money center banks. And there's been a big expansion in these overnight loan markets and new financial instruments such as negotiable CDs. Checkable deposits have decreased in importance as a source of bank funds, and banks now borrow regularly from each other and from other sources too. Capital adequacy management. Now, this is a little bit more complex. Bank capital also helps the bank in terms of being a cushion. So bank capital meaning the value of the shares in the bank. The amount of capital affects the return for the owners of the shares, so equity holders of the bank. And it's also, under Basel, it's a regulatory requirement. So let's have a look at an example here. Let's have a look on the right-hand side. We have a high capital bank, and on the left-hand side we have a high capital bank. Right-hand side we have a low capital bank. So let's start off on the left-hand side. This is a high capital bank. In other words, it's got 90 million in loans, 10 million in reserves. It's got 90 million in deposits, and the remainder there on the liability side is 10 million. Okay, so let's look at a situation where so those are the two different types of banks. So in the right hand side, the low capital bank, it's got more deposits. That means the shares are worth less. Now on the second line, let's have a look and see what happens if, for instance, 5 million of the loans go bad. In other words, whoever the bank's loaned to, the companies, go bankrupt. That typically happens in a recession, by the way. So here we have assets going down by 5 million on the bottom left-hand side T. What does that affect on the right-hand side? It has to affect something, because remember this is a balance sheet. Well, it affects the bank capital. So what would happen here is the share price on those bank shares would fall by 50%. So shareholders would take a big hit there. But they have to, because of course the loans to the bank have gone down significantly as well. Now let's have a look at what happens to the low capital bank when you get 5 million of the loans going bad. Well, same thing on the left-hand side of the balance sheet. Loans go down by the 5 million. On the right-hand side, we have just 4 million in terms of the value of the shares. So we've got to subtract 5 million from the 4 million, and we now have minus 1 million. What does that mean? It means the shares are worth absolutely nothing. What it means, if you look at it, is the amount that the bank has is 95 million, is greater than what it owes to the depositors, 96 million. So in other words, with the low capital bank on the bottom right hand side T, this bank is bankrupt. And we can do some other calculations here to look at how the return on equity and the return on assets are related. So we defined in the actual PowerPoints for the actual chapter, the book chapter, return on assets and return on equity. And we can then define something called the equity multiplier, which is the assets divided by the equity capital. So in which case we can write the rate of return on equity is equal to the rate of return on assets multiplied by the equity multiplier. What this says is that if you have a lot of assets compared to equity capital, then the rate of return on equity is going to be high, Sure. But on the other hand, obviously, if the bank gets into trouble, this could be a problem. So, in other words, it's a trade-off between giving the shareholders a good return in terms of the dividends and the security of the bank in case something goes wrong with its assets. So there you go. It's a trade-off between safety and returns to equity holders. So the benefits of having significant capital are that makes their investments safer. And so you hear a lot in the press about banks have adequate capital. What that means is that the liability side of their balance sheet, the value of the shares, is a significant amount of the liabilities. Why? Because that then acts as a cushion if anything goes wrong with those assets on the left-hand side. It's obviously costly to the owners of a bank because the higher the bank capital, the lower the return on the equity. So the less the return on that equity, and presumably the less the shares are going to give you as a return. So the choice roughly depends on the state of the economy and the levels of confidence that people have going forward. And here we're going to do a quick application and then that's it, and we'll finish up. So as the manager of the First National Bank, you have to make decisions about the appropriate amount of bank capital to hold in your bank. Our discussion of the strategies for managing bank capital leads to the following conclusion, which deserves particular emphasis. A shortfall of bank capital is likely to lead a bank to reduce its assets and therefore is likely to cause a contraction in lending. So if there's not enough bank capital there, then that can lead to also the bank on the asset side getting rid of assets. How a capital crunch caused a credit crunch during the global financial crisis. So shortfalls of bank capital led to slower credit growth, huge losses for banks from their holdings of securities backed by residential mortgages. Those mortgage-backed securities all went belly up, or many of them went belly up. That caused bank capital to lose value. So shares of banks tumbled. A good example of this was the share price of Citibank. It was in the thousands. And I remember in the middle of the meltdown, it went to less than $1. So a massive fall in the value. And the banks couldn't raise much capital during a recession. In fact, in any recession, they find it difficult to raise capital on a weak economy and had to tighten their lending standards. So that meant that if they can't raise the money to lend, then they're basically not going to lend. And so we get this so-called credit crunch. We've kind of talked about most of this, but I'll quickly run through it because it was in our list. So managing credit risk, screening and monitoring. Screening, obviously, when people fill out the forms initially to borrow money, then that's when you can screen them by asking the right questions. You can specialize in lending. That makes it easier to understand the industry that any borrower is in. And monitoring and enforcement of the restrictive covenants. So to make sure that whoever takes the loan follows the rules written into that loan. Those long-term customer relationships we talked about, character, I think Brandl called it, loan commitments. So, what are the loans has the borrower got? What are the commitments do they have? Collateral and compensating balances, we talked about those already, and credit rationing. So, only giving loans out to who you think is a good bet, and being careful not to just give out to anyone. This looks at interest rate risk, which we covered already, but you can see here on the First National Bank, there are rate-sensitive assets of 20 million, fixed-rate assets of 80 million, rate-sensitive liabilities of 50 million, and fixed-rate liabilities of 50 million. Notice both sides add up to 100 million, as they should do, because it's a balance sheet. So here we can calculate our gap analysis. So rate-sensitive assets minus rate-sensitive liabilities. times the change in interest rate. So here you take 20 minus 50, so it's minus 30 million times changes in interest rates. So if interest rates go up, this bank's going to be worse off because bank profits are going to fall. And I'm not going to cover the other things because we didn't cover them. Duration analysis, we covered this, that the formula for this is the percent change in market value of security H minus the percent point change in the interest rate times the duration in years. This is just a kind of a weighted way of doing a gap analysis, if you like. And we kind of didn't talk too much about off-balance sheet activities, so let's quickly do those and then we finish up. Loan sales, so these can be secondary loan participation. When I got my mortgage, my first mortgage I got here in the US, it was immediately sold off to someone else. So it went on the balance sheet of a bank, but then they sold it off. And of course they made money from that. So those so-called secondary loan participation. That's the way the banks can make money. Generation of fee income. So apart from the fees to have my account, servicing those mortgage-backed securities and creating these structured investment vehicles which can potentially expose banks to risk, as happened in that global financial crisis. So in other words, creating those mortgage-backed securities. Trading activities. So if you're a large bank, you'll have a trading desk and you'll be able to trade derivatives and maybe do foreign exchange transactions as well and speculate. Of course, a principal agent problem arises here because you often don't know what the traders are doing, and some of the most spectacular bank failures have been known or have happened because the bank didn't monitor what the traders were actually doing. You can get internal controls to try and solve that problem. So do separate the trading activities and the bookkeeping. Most of the problems that have occurred in terms of banks even going bankrupt because of a single rogue trader can be solved by separating out the bookkeeping and the trading activities. Limits on exposure, so telling the traders that you can't be exposed by any more than this amount. So you monitor the risk. So-called value at risk, which is looking at the amount of risk in various scenarios and how much value you would get out of them. So in other words, what would happen to your position. And then stress testing. So in other words, actually setting up scenarios and looking at how the bank overall would fare if this scenario came to pass, given its current positions. And finish up by talking about Barings. Barings was a venerable British bank. It was more than 100 years old, and they had one rogue trader whose name I forget now. But anyway, he ended up in the Singapore office, which was an office of the bank, and he got his wife hired into the back office. So basically they cooked up a scheme. He would take these huge positions, she would cook the books, hide what was going on, and that was fine when things were working out okay and he was making money. But when he wasn't, and unfortunately several of his bets went horribly wrong, then it wasn't fine. It wasn't fine in the sense that he realized that if it came to light how much he'd lost, he would lose his job. So he had an incentive to bet ever bigger and bigger amounts, to the extent that he bet so much that he lost the bank millions and millions of dollars, and effectively bankrupted the bank. So it now no longer exists. Okay, as you can tell, I have a baby to look after here, so thank you very much.